Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Lloyd Ippolito CPA out of New York, and he just gave us some really good advice on some year-end tax planning that some of you listeners may be able to implement here in the next 30 days. Anthony, what was a takeaway or two that you had?
Well, for me, it would be if you really sit down, if you look at all of your expenses, one of the top ones, and it could even be the top one, could be your taxes. But most people don't act like that's their biggest expense. Meaning we spend, time calling our cable provider or DirecTV, saying, hey, we're going to cancel. So they will throw Sunday Ticket or free HBO. Right?
Is that how you do it?
No, not me, but I'm just saying we spend all this energy and time trying to save a couple bucks here, but let's look at some of the big ones.
Yeah.
Right. Your taxes are one of your biggest expenses, and there are some things that you can do. And so Lloyd talked about some things to do before year end. And I know we actually broke this interview into two pieces. The next one, we dive a little bit deeper into some of the tax changes. So there was some cool stuff there. So I'm looking forward to this info getting out there. Cameron, for Lloyd, what was the takeaway for this part one?
Part one, he had some really good suggestions on some year-end tax planning, which you just kind of alluded to. So my takeaway that I had was we also asked him kind of how he became introduced to infinite banking. And what I really liked was his point of view when he approached infinite banking. He kind of approached it from a student's point of view. He was trying to learn. It was suggested, he saw it on the thread and he said, hey, what is this? And started going down that road of just kind of questioning it and trying to figure out what it was instead of really just dismissing the idea and brushing it aside, which I think sometimes a lot of us have done in the past. So I really appreciated that. And he's kind of grabbed these ideas and really implemented them pretty well over the years as well.
Perfect.
Yeah.
Enjoy the episode.
Take care. Lloyd, if you could, let's dive right into this. What is some advice that you may have for our listeners for some year-end tax planning? I know we're coming down to the end of the year, but if you got anything to share, that'd be great.
I'm going to start generically. Let's look at where your income is. If you're somebody, we talked about how many of these new tax provisions, and which again, in many ways are punitive. We talk about how many of them kick in at the $400,000-$500,000 mark. So let's see where you are with respect to that. Again, we have 11 solid months under our belt as far as data. Let's extrapolate that onwards. Let's consider any extra payments or expenses you might have. And this may sound like elementary tax advice, but in some sense, it's tried and tested. Let's see what payments we can accelerate and what we need to prepay for the next year. And one of the great opportunities with infinite banking is that ability that if we need to prepay an expense, that we have a source of capital that allows us to take advantage of that. Especially if that's going to be the difference to what keeps us under that $400,000 mark or so.
Awesome.
Great point. Yeah. I like the tie-in with infinite banking. I wasn't seeing that. Good job, Lloyd.
Lots of things he doesn't see. Go ahead.
Actually, funny enough, Anthony, I think that's something you've mentioned before on another podcast that I like that myself. I think you talked about buying the tax software.
Oh, Lloyd.
You the man, Lloyd.
Consummate guest. Well done. Well done.
I wish we could buy our tax software early. We buy it, we bought it at the end of October and, we don't have it yet. So I can't imagine how much earlier I could pay for it.
Okay. Awesome. All right. So great bullet point there. What else you got, Lloyd?
Cryptocurrency, we talked about how those are now going to be subject to the wash sale rules. So, and again, there's a fine line of doing this just to make sure you don't add more money into it within the 30 days, and it happens across years. But if you are able to, if you happen to get into crypto and you have a loss position right now, but you still are bullish on it going up, sell it, buy it back, and that way you'll be able to take advantage of that loss deduction in the current year.
Okay, so you could. So what? And I know we just we just discussed that in our other podcast, but I think this one's going to go first. But in essence, what Lloyd's saying is in 2022, they will limit, called the wash sale, meaning that if you sell a stock and then turn around and buy it within 30 days, they're not going to allow you to deduct the loss in that year. But what you're saying is there's a little loophole. So if you do have a loss in the crypto, you could sell it today, then buy it immediately, and you can lock in that loss, right?
Yes.
That is a great tidbit. I didn't even wasn't even aware of that about the crypto. That's cool. What else? What else are some things that we can do, Lloyd, before the end of the year?
What else are some things that Anthony's unaware of?
Well, I think the podcast's over.
And this one doesn't have to necessarily be done at the end of the year, but this is something to keep in mind as we go into the next year. It's, consider solar panels. In fact, actually, this could be an anti-planning opportunity. This could be something where you may want to, if you're on the verge of turning those panels on, you might want to defer that until next year to take an increase in the tax credit, because the increase in tax credit is based on the date in which the asset's placed in service. So I wouldn't even consider having those solar panels turned on until January of next year.
And what is the change that's taking place at January 1?
The federal tax credit goes from 26% to 30% of the purchase price of the asset.
Okay. So if somebody's considering solar, hold off 30 days.
Yes.
At least turning it on. Gotcha.
At least turning it on. I mean, if you're still in the idea of whether you're considering it, then you're not going to get it. You're probably not going to get permits within the 30-day window.
Cool. What else?
Meet with an advisor. Anytime we're talking about, changes in the tax law or any sort of planning opportunities we could take, it's all going to be dependent on your specific situations. And there's a lot that we could tell based off somebody's tax return. And sometimes it's sloppiness on the part of their previous preparers. Sometimes it's things that we could do better. And sometimes it's things that you really overpaid in tax. Sometimes you underpay in tax, but, just even errors in the tax calculation that, we look at somebody's return. We had somebody that we came in with. He's been with a couple different preparers over the course of the previous 5 or 6 years before he came to us via WealthAbility. And when we looked at one of his returns, we had to go back a couple years because he had a sale of one of his real estate properties. So we went through the returns, and it turns out there were some discrepancies as far as filing status. He was eligible for head of household, but in the number of preparers he had over the couple different years, he was filing as single. So we were able to go back a couple of years and get him a couple $1,000s of tax refunds that he just wasn't expecting, just based on filing status, because sometimes these things are significant.
Interesting. I have been hanging out with Anthony, and over the years, he's been telling me that tax preparers and accountants are the closest thing to perfection that there can be. So you telling me that somebody or some of them may make mistakes is a surprise, Lloyd. Thank you.
Well, okay. So, Lloyd, so we're approaching the end of the year. What are some other things that you'd recommend us to do before the end of the year, or maybe don't do before the end of the year?
Sometimes we hate to suggest it, but sometimes qualified plans do remain a valid tax planning opportunity. Again, it kind of depends on what type of asset. If somebody is in the crypto spectrum, that's sometimes a perfect place to do it, where they can self-direct the assets into, crypto-based investments and have them be tax-free. I'm personally not a big fan of using tax-deferred accounts especially as far as tax planning is concerned. Economics, people can argue this one way or another. But that certainly doesn't mean we don't tell clients to take advantage of it when they think it's appropriate for them.
No, and I would tell, I know we bashed qualified plans on the other podcast quite a bit. There is a place for them, right? And particularly if you have a year where you had a really good year and you not sure if maybe that was like a one hit wonder, but so the income goes up, but in the future years it's going to be down. I could see that taking advantage of the tax rate. Other than that, I
Well, if
can't
it
really see.
gets you under the 400,000, certainly.
Okay, right. Yeah. Again, to get under the 400,000, there can be some good there there can be some good reasons to do a 401k.
We basically kind of have a spectrum the way we think about different tax planning opportunities. And, it could be elimination of taxes, it could be deferring the tax, it could be converting the tax into, something that's taxed at a lower rate or taxed preferentially, based
Mhm.
on different situations. And then tax credits and deductions are themselves planning opportunities. We consider deferral to be one of the least advantageous means of doing tax planning, but it is still a method.
Okay, what if somebody is maybe on the fence of buying like a large asset?
Well, again, we're kind of under the Kiyosaki umbrella. So I guess my first question is: are we talking about somebody who's actually buying an asset, or are they really buying a liability?
Mm,
Touche.
yeah, touche. But because I'm also looking at an asset in regards to the IRS terms as far as depreciation.
So thankfully, we have no changes to depreciation as far as specifically bonus depreciation.
Hmm.
That still remains a valid uh, tax benefit, as does the 1031 exchange. The 1031 exchange was rumored to be on the chopping block in earlier iterations of this bill, and that's gone too. So again, buying an asset could be another valid means of deferral, especially um, as far as using that depreciation to put yourself in a different tax bracket. Again, depreciation sometimes is also a double-edged sword, and there's two other considerations we have to make, and that one of them is, well, you're taking the bonus depreciation. Well, that means you don't have depreciation deductions in the other years. So if that's something you're kind of counting on to smooth your income, you're going to have lower income in the first year, and you're going to have higher income in some of the other years. And the other thing we have to take into consideration is a lot of states have decoupled from the tax code when it comes to bonus depreciation. And basically, what decoupling means is they're going to base their calculation of taxable income differently than the way the IRS does. And bonus depreciation is a common add back. Here in New York, that's one of the um, differences we have to put up with when we go to prepare tax returns. Basically, you're going to have somebody who's taking bonus depreciation. They'll get it on the federal return, but they don't get it on the New York return.
Mhm.
Now, again, bonus depreciation is only one of three ways of expensing an asset. Um, and depending on the type of asset, some of the other alternatives we consider are Section 179, which allows you to expense equipment.
Okay, yeah, good point, Lloyd. Because I think a lot of times we're chasing tax deductions. And that's one reason why a lot of people might be chasing a 401k. But before the end of the year, there's a lot of pressure to buy an asset so you can depreciate it during 2021. But one thing we have to, and you made a good point, Lloyd, is we gotta kind of look at, well, what tax bracket are we going to be in next year or the year after that? Because that bonus depreciation, we take it now, that means we can take it in the future. So if you think your taxes are going to go up, or maybe your income is going to be the same, but taxes themselves are going up, you may be better off not taking that bonus depreciation so you have it in the future years.
Yeah, like if somebody's making $800,000 now, them taking bonus depreciation on a new piece of machinery for their business, it's not going to make a lick of difference to them, what that bonus depreciation is, because they're still going to be in the bracket they are now. In fact, they're better off deferring the purchase of that asset, or at least deferring bonus depreciation specifically. We're electing out a bonus depreciation, say, because they're going to be in a higher tax bracket next year because they'll go from 37 to 39.6. It doesn't pay for them to take it now.
Okay, now Lloyd, you'd mentioned at the beginning of maybe of putting some you're going to buy in maybe in 2022, buying them here so you can depreciate it or expense it. But let's talk a little bit about what some of those might be, right? What are some examples? I mean, we've talked about assets, which are the big one, but What about somebody's rent or their office rent or property taxes? Is that something that we can manipulate as well?
It depends. Certainly, again, if we're anticipating being in a higher tax bracket, that makes your deductions and tax credit much more valuable in 22 than it does in 21. Again, sometimes deferring the outlay of the expense can be advantageous as well. That particularly identifies with people who are available or able to take the research and development tax credit. The R&D tax credit is a credit based on your expenses, but the value of the credit is based on what the current tax rate is. So, for us gap geeks out there, generally accepted accounting principles, we have a concept for gap called a deferred tax asset. And a deferred tax asset is just based on the idea of how much a tax benefit's worth in the future. Because us accountants are nerdy enough that we want to actually record that on the financial statements as an asset. And when we do so, we basically use enacted tax rates. So basically what that means is a tax credit is worth a lot more at 26.5% than it is at 21%. So what is that going to mean for some of these companies? They're going to have huge valuation adjustments for any deferred tax assets on their books. So we might be seeing, and I think that's going to be important to consider in the markets too, because that might, if that's not appropriately acknowledged by an investor, then they may look to see a company being a lot more profitable on paper than it really is. And conversely, the same thing goes for companies that have deferred tax liabilities on their books. Same thing, it's going to be valued based on enacted rates. So you could be seeing these liabilities now increasing based on the change in tax rates.
Interesting. Now, Lloyd, one thing we've talked a lot about is different, if you're an employee versus a business owner and how different that they're taxed. What are some of the advantage of having a business versus just being an employee?
Geez, how much time do you got?
Yeah.
I mean, let's start with, Anthony, how did you get to work today?
I drove my car.
All right. When somebody goes to drive a car, you generally consider that a commute, right?
Mm-hmm.
Well, if you have a home office and you're coming from your home office to your main office over at Infinite Wealth, you have to deal with the traffic and then you have to deal with Cameron. But once that's all said and done, that's now a commute that's no longer a commute. That's travel between two offices. That's business miles. You have an employee do that. That's their commute. They don't get that option of having to start from a home office. So that's money right there. That's not getting any tax favored treatment right there.
No, you're right. And also the cell phone, right? Something that employees can deduct. Now, what about Paul Mitchell hair products, Lloyd? If you're a business owner and you're on, TV and video, can Cameron record Paul Mitchell?
Unfortunately, no. And there's actually a litany of case law based on the idea that certain expenses, particularly clothing and personal care products, they're just inherently personal in nature. And in fact, I think that I don't remember, was a tax court or was the IRS actually weighed in on Lady Gaga's meat dress, that they basically actually did consider that to be a business deduction just because, well, nobody else is going to wear a meat dress in public.
Interesting.
So Cameron,
that is a shame.
If Cameron wants to use meat-based products in his hair, he might have the blessing of the IRS.
I mean, it's a shame too, because there is a lot of money spent annually on product.
Now, Lloyd, let's shift gears here a little bit. And now I know we first got introduced to you because you were inquiring about infinite banking. I'd be curious if you could share kind of what motivated you to pursue infinite banking.
So I kind of first learned about the idea of whole life insurance based on my father. My father had a good deal of his money and his outgoing expenses in life insurance premiums, and they were specifically whole life. And in doing my own research, I basically asked the question, Dad, why do you put all the money in life insurance when you could buy term and invest the difference? And his answer was, well, the return is guaranteed. So that kind of hit me for a second. And, basically I did more research, and going along that mindset of buy term, invest the difference, I actually came across an article that was, they were actually mocking whole life insurance and basically referred to this concept called infinite banking. Infinite banking, that sounds interesting. What is that? So I did a little bit more research and learned about this whole idea of using your life insurance, not so much as an investment base, but based on liquidity, based on the idea of capital preservation and accessibility. And I'm thinking, well, that's certainly been the case over the years with my father too, just having having access to this money for different opportunities that come up. Um, and then from there, basically I was, read a lot more about it. I got my education, so to speak. And anytime I have a client that's interested in it, the first thing I do is I give them a copy of Becoming Your Own Banker and say, look, if this is something you're interested in, let's talk. But don't do it on my say. So make sure this is the right thing for you. Then I go through the practitioner list on the Infinite Banking website, and I see one that appeals to me because he's a CPA. Now, I wasn't a CPA yet when I first met Anthony, but that certainly gave me the confidence that Infinite Wealth was going to be the right group for me. And here we are years later.
Perfect. Well, thank you, Lloyd. Now, years later, so tell us do you mind sharing how you've used your policies?
Absolutely. So, uh, you know, even with the firm itself, joining WealthAbility itself, that's something that we were able to use the policy for to take advantage of those upfront costs as far as joining the network, which has been a huge, a huge positive impact into our business as being part of that network. I've also learned about the idea of building passive income through land flipping. So I have started my own business flipping land, took Mark Podolsky's courses as well as his coaching program, and I'm growing the business that way. And right now I'm just shy of $1,000 a month on passive income on flipping land.
Nice. Congrats,
Which
Lloyd.
I'm pretty happy with. And, we're working with the coaching program, and I have high hopes of building that up even further.
Oh, awesome.
Nice. Congrats.
So
Thank you.
So you've used it and to invest in your business, and you've actually created other businesses as well.
Absolutely.
Okay, cool.
In process of also buying a turnkey rental property as well.
Attaboy. Lloyd, what advice would you give someone that's on the fence about IBC? They're kind of looking at it and wondering if it's for them or not.
Well, specifically, even for the entrepreneurs, I even try to point them to the tax benefits. And I tell them, look, in many senses, it doesn't get much better than this. You're going to be earning a return on your cash value that's tax-free. You're going to use this in your business. And, we'll do things like setting up the lead lock and let them deduct that interest. So not only you're deducting the interest and the interest expense, and the interest income is tax-free. To me, that's the perfect definition of tax arbitrage.
Yeah. Best of both worlds.
So I motivate them based on that, respect. And also, let's look at where the alternatives are that we can place our money. And I tell them, let's not compare it to the stock market in terms of return. Let's compare it to the stock market in terms of its safety and liquidity. Again, I work with a lot of real estate investors, and I explain it to them using the concept of where are you putting your capital when you're waiting for the next deal to come up? Where are you putting your capital while you're waiting for these black swan events where you could buy up a whole bunch of real estate? And in many cases, they answer that as either it's a savings account, or even sometimes a checking account, and try to help them in that regard so they could, have some decent return on the money while they're waiting to deploy it. And if it's not stuck in something like a 401k, that they're even able to get access to it for that matter.
Well done, Lloyd, because that's really what it should be compared to, right? Is what's the alternative? Where are you storing that cash, right? And thanks for sharing that, Lloyd. It's always good to hear from a CPA's perspective. Don't give me that look, Cameron.
What, man?
Cameron just loves the more CPAs, the better that he can hang out with. You know what, Lloyd, you talked a little bit. You mentioned WealthAbility. Would you mind explaining what that is and how people benefit from it?
So WealthAbility was essentially a network of like-minded accountants. It was started by Tom Wheelwright. Tom Wheelwright wrote a book called Tax-Free Wealth after he had Robert Kiyosaki as a client. And Tax-Free Wealth is one of those books that's marketed under the Rich Dad umbrella. And Robert Kiyosaki talks about it in his book, Rich Dad Poor Dad. He talks about the cash flow quadrant. And one of his comparisons of the people in the B and I quadrants versus the E and S quadrants is the taxes they pay. And Tom goes in more depth in his book as far as what those differences are, and talks a little bit about some of the different planning strategies that can be implemented. And he basically was at the point where he was getting so many inquiries based on the book, he could no longer handle them, and try to get other accountants to be able to take this load, in an effort to get all of the entrepreneurs out there to take advantage of paying the least amount of tax possible. So our firm is Master Tax Services, and we pride ourselves in helping people build wealth by saving taxes.
Perfect.
We talk about, everyone's heard the idea that, if you have a penny and you let the penny double each day for 30 days and you run it through it both with and without income taxes, how different it is. And you're thinking, well, you're only knocking off a couple of cents. How much significant can it be? Well, that's the significance and the difference in compounding. And like I said, for the same reason we like infinite banking, the same ideas can be, just to the greatest extent possible, applied to your entire portfolio of investments and activities. And again, we're holistic planners. Well, if you ask us whether it's a C and an S, C corp or an S corp, our answer is yes, because we want to use which one is right, and we're not going to limit ourselves to just one. We put together these plans and diagrams. So the idea is, well, this is what we think. Let's have you run this through your attorney, and any other advisors that are necessary in your individual circumstances. We work with people that are, for example, they're real estate agents. We want to make sure their broker's okay with this too, as far as the type of entity. And maybe an LLC tax and S corp isn't good enough for them. Maybe they need an actual corporation.
Lloyd, thanks for joining us. It's Anthony and I have been doing this for quite a while, and it's difficult to find an accountant, a CPA that is kind of a forward thinker, that is proactive. And so what I always tell somebody is, if we find one, man, you got to hang on to them. They're worth their weight in gold, and you definitely qualify. And so where's a good point, or what I should say is that I will make sure that we've got your information in the show notes, so that somebody, if they want to follow up with you, if they want to talk to you, that they can contact you. And I believe that's going to be a Calendly link. Is that right?
That is correct.
Perfect. So Calendly link, you'll be able to click that and get right into Lloyd's calendar, have a conversation with him, and discuss your situation and see if it'd be a good fit for you.
You know what? We're also going to include in there a link to Tom's book, which is a great book, Tax-Free Wealth. And Lloyd, you also mentioned a buy term and invest the difference. And you probably know we did the math on that. Mm-hmm. Right? Is it better to buy term and invest the difference, or is it better to buy whole life and invest the cash value? And we went through and did all the math. So we will include the link to that video as well. Well, Lloyd, thanks again, buddy, for coming on our show and kind of sharing your story and how you can help people save money in taxes.
Thank you for having me, guys.
Absolutely.
Go make it a fantastic day.
Take care.